All right, folks, welcome to the Heritage Wealth Planning YouTube channel. I'm going to go over some basic investments. Investments 101, I'm going to call this, because if you can get this one aspect correct on your own financial planning / investment management, you're going to be so much better than the vast majority of your peers, without question. When you're done listening to this, you say, man, that was too simple. I'm telling you, when it comes to investing, keep it simple, stupid. Keep it simple, stupid. You do not need to be complex. In fact, what I say in all my books, all my writings, that complexity is the enemy of good financial planning. Very, very few people, when they have complex financial lives, has their stuff squared away, at least regular middle-class people. I mean, maybe Trump and Buffett and all those guys. But for us, just regular folks, just working an honest living, very, very few people have complexity in their financial lives. So I'm going to share with you an article that dates back to 2011 from the Journal of Indexes. The Journal of Indexes that dates back to 2011. That's called How the Dumb Money Gets Divided. Because once you grasp this one aspect of your investment management, you will forever, ever be smart. And you're going to be smarter than 90% of your peers. It's just that simple. It's nothing fancy. So welcome to Heritage Wealth Planning YouTube channel. If you like what you see here, click on that little button down there that says subscribe. As always, once you subscribe, hit the little bell to be notified for future content. We do a video, man, a couple times a day now. I tell you, so I'm going through my list of my litany of stuff that's this thick of various articles and stuff that I've read and pulled off Wall Street Journal, various magazines, trade rags, the whole thing for years and years and years, which I have not been able to share with anybody because I work for another firm. But now that I'm working on my own, I can share this until I'm blue in the face, and that's what I'm going to do. And so this one, again, the May-June Journal of Indexes of 2011. And the reason why it's so prescient, because he actually, the guy who writes it, the guy's name was Richard Ferry, F-E-R-R-I. And I think he's written a couple books. I think he actually might even had a podcast that's pretty good, or maybe a TV show. I can't remember. But he's definitely written a couple books on index funds. So I'm just going to read you a lot of this because it's just fun. It's fundamentally foundational for you. It really is. Tactical asset allocation is a zero-sum game. So let me explain what tactical asset allocation is. I'm going to do better than you, right? Or the market would be you, and I'm so smart, I'm going to do better than you. And what he's saying, Richard's saying, is this is a zero-sum game. It's completely correct. If I do well, inherently, you will do worse than well, because we're not growing the pie. I'm just taking it from you, or you're taking it from me. When someone underperforms the market, it means someone else must have outperformed before fees and expenses. Remember that, before fees and expenses. Lock that in your brain back there. The grand total dollar-weighted return for the average investor in all funds over the past 10 years. Now, this is important because 10 years, I'll show you the chart here, was from 2000 to 2009. So everybody and their mom says 2000, 2009, you didn't make any money in the market. That's incorrect. That's absolutely incorrect. The grand total dollar-weighted return for the average investor in all funds over the past 10 years was 1.68%, compared with a time-weighted 3.18% for the average fund, according to Morningstar. So essentially, the average fund made 3.18, not the average fund. The market made 3.18, but the average investor essentially made 1.68. Where did the extra 1.5 go? Much of it went to brokers. Brokerage firms and their trading desks. Yep. And that's where it goes back to the performance before fees and expenses. Finally, believe it or not, a portion went to the investors who developed a passive strategic asset allocation strategy and rebalance asset classes annually. Investors who lose with their tactical asset allocation strategies indirectly provide excess returns to investors who religiously rebalance their strategic allocation. All right, so a couple things. Tactical allocation is, I think the market is going to go here, so I'm going there. Kind of like what Wayne Gretzky says. I'm not going where the puck is. I'm going where the puck is going to be. So I have to presume I know where the puck is going to be. Now, Wayne Gretzky did. Old Josh does not. The same thing goes with investments. Warren Buffett does. Old Josh does not. So once you kind of get that, I'm telling you, it's what's the word I'm looking for? Well, it makes you realize that you aren't Warren Buffett. Let's just put it that way. There's no Warren Buffetts other than Warren Buffett. Charlie Munger, maybe, and he's Warren Buffett's partner, but they aren't you and they aren't me. So basically, that's tactical allocation. I'm going where the puck is going to be as opposed to where it is. Strategic asset allocation says, look, I don't know where the puck is going. I know where it is today, and I'm just going to build a portfolio of like 7 asset classes with 12% in each, or 12 asset classes with 7% each, or 5 asset classes with 20% each. And the asset class would be large company stocks, small company stocks, international stocks, emerging market stocks, and bonds, or something like that. And I'm just going to put 20% each. And every year, I'm going to go back and make sure they stay like that. That's strategic allocation, the boringest thing in the world, and yet it works. And so let's see what we got here. And just as you know what that is, strategic allocation versus tactical allocation. Tactical allocation is market timing, doesn't work. Strategic allocation is recognizing, humble, that's the word I'm looking for, being humble enough to recognize you can't time the market, so you're just going to sit back and let the returns roll in. Investors who lose with their tactical allocation strategies indirectly provide excess returns to investors who religiously rebalance with strategic allocations. And rebalance means once a year. This occurs because rebalancing naturally forces investors to sell some amount of their better performing investments and buy more of their worst performing ones. So in 2009, let's just say you rebalanced at the beginning of 2009. The U.S. equity market, well, all equity markets were getting hammered. You know what did well in 2008 was government bonds. So you'd have to move money from government bonds and put it into equities, which meant you had to sell a winner and buy a loser. Now, there is a strategy that says cut your losers, let your winners run. I do believe that when it comes to individual stocks, absolutely, without question. I'm not advocating individual stock investing. I am advocating an active, tactical, strategic approach with ETFs and index funds. And you say at the end of the day, just once a year, I'm going to rebalance to make sure everything is 20, or everything is 25, whatever your tactical model, your strategic model is going to be. Although it seems counterintuitive to do this, over time, it increases portfolio returns and lowers risk when you're buying low and you're selling high. Crazy, right? Strategic asset allocation and regular rebalancing provides what is widely referred to as the only free lunch on Wall Street. It's a nice thought, but every economics student knows there's no such thing as a free lunch, especially on Wall Street. Any extra gain in one person's account is a loss in another. The loser in this case is the investor who believes sector rotation strategies and market timing decisions can beat the market. That investor loses 1.3% a year, according to Morningstar. This loss amount from trading mutual funds or other stocks, investments, ETFs is controversial. My opinion is that investors lose at least 1% each year from these activities, and there's lots of studies that show that's correct. Assume 3 investors each start to invest in January 2000 with a portfolio of 45% in U.S. stocks as represented by the S&P 500, 15% international stocks as represented by MSCI EFA, which is international, developed international, and 40% in bonds as represented by Barclays Capital Aggregate Bond Index. So you got 45% U.S. Large cap U.S. stocks, 15% developed roughly large cap international, and 40% bonds, U.S. bonds. One investor uses tactical allocation in an attempt to beat the markets and underperforms them by 1% annually, the cost of his trading. The second uses a buy and hold strategy and lets the portfolio sit over a 10-year period, thereby earning market returns. The third investor rebalances every year for 10 years and thereby outperforms the tactical allocator and the buy and hold investor. And he shows us this right here. This is exactly what happened in 2009. Here's us. This is our tactical, I keep saying it, strategic rebalancing. So we're doing 2 things. We have a strategic asset allocation. Again, in this case is 45, 15, and 40. And we're just letting that puppy sit. But every year we're rebalancing it to make sure we stay at 45, 15, 40. Here we got a approach where we're not going to rebalance it. We're just buying 45, 15, 40. We're letting everything sit. And here's what we're doing when we're trying to beat the market. And because of our fees, we're losing to the market, which is this guy here. And then we're getting smoked by the guy who's doing the strategic allocation with the annual rebalancing. The rebalanced portfolio picked up an extra 1%, or actually 0.9 percentage points a year over that decade. That wasn't rebalanced over the last decade. And he picked up a whole lot more than that over the tactical approach to market timers. The excess returns earned from strategic asset allocation represents a real wealth transfer that takes place in the marketplace. You got to remember that. You're actually making money from that guy because he is cocky enough to think he can beat the market. And because of that, you're taking money from him because he can't, because it costs too much. This return is enough to make up all the fund fees and trading costs that index investors incur, leaving these investors with very close to market returns. So essentially what he's saying is at the end of the day, with no trading, essentially no trading costs, you still have a little bit, but a little bit of fees, a little bit of trading costs. Even if you don't rebalance your portfolio, you just let it sit there. Essentially, you're getting that for free because the market timer, the tactical asset allocator is essentially losing. I keep saying essentially is losing the money and giving it to you. Now, if you just rebalance, though, you can beat the passive guy who's just sitting there buying and holding by 1 percentage point a year. I don't know the guy forward, but that's what's happened over 2000, 2009. Again, when everyone says it's a lost decade, we didn't make any money. That's bullcrap. You did make money if you had a rebalanced portfolio, a strategic allocated portfolio that's rebalanced. Putting it all together. Let's see. Discipline. Investors who use low-cost index funds and ETFs and strategic asset allocation earn market returns. Investors who use actively managed mutual funds lose about 1% a year over index funds, and our investors who employ both tactical timing strategies lose another 1%. Investors who use both active funds and a tactical asset allocation strategy are expected to underperform the all-index strategic allocation strategy by 2 percentage points a year. Now think about that. If the market gives you 10% and you're only getting 8 because you have all this market timing nonsense and you're paying big fees, you're leaving 20% of your performance on the table. 20% each year. 20%. That's big time. And remember that means if you have $100,000, I get 10 and you get 8. That means it took me 7.2 years for my $100,000 to go to 200,000. But it took you, if you had 8%, it took you 9 years. It took you 1.8 years longer to double your money. Disciplined passive investors are smart money investors. They follow long-term strategic asset allocation strategy based on their needs and fill their portfolios with low-cost index funds and ETFs. They don't mistakenly believe they have the skill to pick out outperforming funds and know they don't have the timing to rotate in and out different. We're not talking taxes here either, my friends. If you're rotating in and out, that means you got a lot of taxes to pay for too. Many investors use both a strategic allocation and a tactical allocation. This strategy has been called a core and explore, or core and satellite, barbell, core plus, a variety of other names. The idea is to place part of the portfolio in a strategic allocation using index funds, and then play with the remaining part of the portfolio using tactical asset allocation. I call these combined strategies core and pay more because that's the best describes the outcome. The cost of the explore side is more expensive than the core, and there's no reason to believe that the active management results will be any better simply because there's less of it. Could not agree more. Summary, a high percentage of new money flows into asset classes, sectors, and styles that have had recent high returns. This trend following behavior likely results in a loss of more than 1% a year in investors' portfolio. For active funds, the timing gap, in addition to the shortfall of funds, and the fees, and again, never mind the taxes, is what they're going to have to bear. That's the cost they're going to have to bear. Could not agree more. So anyway, I love it. I think that's a great article. Again, Richard, was it Ferry, F-E-R-R-I, Richard Ferry, F-E-R-I. Now, this is written back in 2011. Hasn't changed my mind in the least. What's happened more? I hope there's more active management because that will give more money to the passive investors, because there is no study that says not only can you not be the market, we can't identify who that person is in advance anyway. We just can't. There's just no study. Now, are there strategies that have proven themselves in the past? We call this evidence investing. Sure, absolutely. Will those strategies continue to prove themselves in the future? No clue. That's why you look at investing is I am buying companies of the United States and the world that are going to grow. Has nothing to do with beating the market, nothing to do with what this guy's doing or that guy's doing. It's just, are these companies going to grow in the capital markets? Will they grow their earnings? Will they grow their dividends? If the answer is, will they grow their profits, which is their earnings? If the answer is yes, then I will make money, most likely. If the answer is no, then I won't make money, most likely. It's literally that simple. It's nothing to do with beating the market. Just be in the market. You got to be in the market. And that's point 2 of this. It has nothing to do with paper. When you're in the market, you've got to understand you're going to get hammered many times a Sunday. There's no getting around that. I always refer back to this chart right here. The red is all the years the market went from high to low every single year. It doesn't matter. There's always a year when the market's down significantly, even when the market is up. So in 1987, the market was up 2%. Did you know that? And yet it was down 34% because of the October crash. Let's see, in 2097, the market was up 20%, but at one point it was down 8%. In 98, it was up 27%, but at one point it was down 19%. I remember that, actually, 98. That scared a lot of people. A lot of people thought that was the LTCM. Is that the Russian devaluation, the Mexican peso crisis? I'm telling you, there's a crisis all the time. It always knocks the markets down. What you can do, develop a passive portfolio, get yourself emerging markets, developed countries, U.S. large and small, the total stock index, however you want to devise that. I don't like bonds in a portfolio. I don't think bonds do anything for you. I think if the alternative would just be to have enough in cash that can pay the bills for a year or two. But if you want some bonds, go just get like this guy is saying, the aggregate bond index, and just be done with it. And you have 4 or 5 assets right there. Stocks, large company stocks, small company stocks, international stocks, emerging market stocks, and bonds. 20% each. Yeah. Rebounds once a year. I'll throw that portfolio up against anybody's. Anyway, hope this helps. If you like the information here, again, subscribe. Don't forget to hit the notification bell up there. Comments are always welcome. I always love to hear your comments. By all means, tell me what you're doing in your investments. Love to hear it. You know, what are you looking at? What are you thinking? Don't tell me what your prognosis is of the markets. Don't care. But if you do have a strategy, maybe you're using a thrift savings plan, you're like, oh, you know, put them in the comments. Absolutely. And of course, thumbs up. Thumbs up always helps. So do that too. We'll see you next. Oh, then go to the blog, heritagewealthplanning.com, heritagewealthplanning.com. We'll see you next time. Thanks, guys.